This is In the Final Analysis. I'm Jim Yockey.
Welcome to the In the Final Analysis podcast. Here is your host, Jim Yockey, and I'm the Media Support Manager, Kylie. Welcome to the episode of In the Final Analysis about investing and decision making. And today, to start off, before we really dive in, I just want to clarify some terminology for our audience. Because we've been talking a lot on the podcast recently about uncertainties, impact on financial decision making. And I often hear, like, especially recently, since we've just come off an election year here in the US, that two big sources of people's uncertainty, anxiety, confusion around their financial choices is the economy and the markets. So I think that actually I'm hearing those terms used interchangeably a lot, which I think is a driving factor of people's confusion. So, just really quickly, could you speak to how closely tied these mechanisms really are?
Well, they're like family members where you have the siblings always arguing. So the idea is the economy. The economy is like a big ocean, you know. And if you have a boat and you're trying to navigate from point A to point B, you have to have some directions how to do that, and then you have to account for the weather. Okay. And economies are largely the same thing. There's another metaphor we could use too, which I'll talk about in a minute. But if you have bad weather coming, there are going to be all kinds of signs. You're going to see clouds in the horizon. You're going to see swells in the ocean start to be bigger, so that you need to adjust your boat, which your boat is basically how you deploy your money into the economy. Because not everybody, but most people work, they save and they spend, and is the fundamental ocean of the economy. So readiness, it depends on your dedication to knowing what the weather is going to do. Well, the same thing with the economy. Now, an interesting thing uh, between the economy and the markets is that the market looks for things they try to plan and predict things, whereas the economy looks at what has happened and what is currently happening. So they have different objectives that they're looking at in order to function. I'll come back to the markets in just a second, but the interesting connectivity that we have in the economy and the markets rests around these discussions that we have about the Federal Reserve and, of course, politics, which, politics is always politics. But anyway, the Treasury Department and the Congress has established a relationship between the Federal Reserve. The Federal Reserve is not a department of the federal government at all. They have a deep connectivity and direction to report to the Congress, and to their obligation is to buy treasuries from the Treasury Department. And the effect of that is to help either accelerate or slow down the economy. And the reason that happens is because that issue of new treasuries, it has the Federal Reserve then buying those, which is injecting cash into the economy. And now that cash has an accelerating movement throughout the economy. So the more cash you have in the economy, the faster it's kind of like pushing down on an accelerator on a car. If you want it to go faster, you push down. If you want you tap the brakes if you want to slow down. Okay, so it's kind of like a vehicle, and that's what the Federal Reserve helps to manage. When the treasuries mature, they return them to the Federal Reserve. I mean, the Federal Reserve returns them to the Treasury, gets paid, and theoretically, systematically, will buy more treasuries and other kinds of bonds as well, more recently. But that's an economic function that attaches the economy more directly, to the markets. Now, the markets, as I said, they have their mind of their own, because they're always trying to forecast what companies are trying to make, and they have an anticipation that their expectations should be met, particularly on a quarterly basis when you go through the quarterly reporting of companies that have stock that is being traded in the marketplaces. And there are other things they look at, because there are synthetic, or I don't want to confuse everybody, but options and futures fall into the market's ability to either slow down the growth, or accelerate the growth, because they can use these derivatives, options and futures, to be able to manage more effectively the portfolios that they're managing. So you have two different real objectives, with have different future points and expectations, or the way that they're evaluating things. So it's evaluation of data, and looking forward or looking backward. So that is the fundamental difference between the two. They are linked, but they're like arguing brothers and sisters. So
Gotcha. Okay, thank you. Okay, so it sounds like that the stock market, as its own entity, has a little bit less of those support beams of the government ties and the Federal Reserve that the economy might have as a whole. So, why would you say that people participate in investing if it has a more uncertain environment?
well, you get paid for risk. So if you have, like with the Treasury, you have very little risk in a Treasury issued note, bill, or bond, because they tell you those have certainty um, and because you at some date in the future, you're going to get your money paid back to you by the government. Okay, when they mature. The second thing is they have the ability to pay a certain dividend along the way. Okay, so you have a completely different investment instrument in those bonds, in practically all bonds. You have a difference, but certainty and prediction is what treasuries have. Other bonds that are available to people have their own credit to worry about, but you don't pretty much don't worry about the credit of the United States. So you're not getting paid as much in bonds, because you're not taking as much risk. You are taking risk of the future when you invest in a company's future through buying their stock. And there's going to be a lot more variability, because their revenues, sales, will either rise or fall or stay flat. So there are decisions that you can make, all of which affect the actual value of the company on an ongoing basis. So you're getting paid more for that because of that variability. Does that make sense?
Yes, thank you. And
Okay.
if one chooses to participate in the markets this way, um, what are often the objectives they're trying to reach through that strategy?
Are you talking about the investors that manage large portfolios, or are you talking about the individual?
Oh, great distinction. I didn't even think about it that way. Yes, I'm thinking about the individual of who is putting their money into this, whether it's through someone managing it or not.
Well, I think we've learned several important things since the early '80s, when when 401ks became part of the retirement uh, uh, universe. Okay, before that, uh, before early 80s, companies had retirement plans that said when you get to retirement, we will average your last 5 years of of, uh, of income salary, and then we'll pay you a proportion of that for the rest of your life. Okay, so that was one kind of retirement, and they began to be replaced by 401ks, where the investment in the 401k was shifted off to the potential retiree, the company employee, for example. So that, and the employee then had to choose between a variety of mutual funds. Originally, the Department of Labor required four types of mutual funds to be in them. The Department of Labor actually, which was a money market fund, a balanced fund, a growth fund. Those are little nuances between those mutual funds, but they left the individual in making the decision about how they should be invested. That introduced the whole concept more distinctly to investing in our country. Um, Eventually, those 401k plans opened up, and you could invest in almost anything, including individual stocks or something like that. So the exposure to investing in stocks through mutual funds and individuals, other individual investments, principally initially through their 401k, added the amount of some education and a lot of willingness to look for higher rates than they were getting either at the bank or with a bond if they happened to own a bond. They were looking, and they were actually forced to be able to make that decision, primarily because of the element of inflation. Because if inflation, like 1979 to 1981 or two, we had enormous inflation of double digits. And so everybody was scrambling around, because the higher inflation, that means the value or your dollars that you're going to spend for ordinary things or extraordinary things is going to be significantly higher. And that's where the Federal Reserve and the Treasury Department and the Congress try to work together in order to levelize or control an element of inflation. And we can talk about that more distinctly perhaps at another time, or I can go into it now. But anyway, the bottom line is we try to manage outcomes of inflation by the administration of several factors, but primarily what I said about moving currency into the economy. Now, one of the things that we're kind of worried about, we had in 2000, we had a situation where the supply of everything happened to be restricted. And once we got out of quarantine, we came back and found out that there wasn't much of what we wanted to buy on the shelves. And so obviously then the supply demand thing happens in the economy. And when there's a lack of supply for demanded products, they're going to cost more. Okay. And then it peaked, a couple of years ago, it really peaked. And then we started moving down again, so that there's a little more rationality with regard to inflation now. But now we're facing another situation, which is the use of tariffs on, companies wanting to sell stuff into this country. The utility of tariffs, if implemented for a long period of time, are likely to raise inflation again. So we'll have to deal with that down the road, perhaps not specifically, but potentially. And it's going to be a little interesting for people to figure out how they need to manage their money through that, along with companies managing how they're going to make money. So it's going to be very interesting. So the idea is making sure that you know what the weather looks like.
Truly.
Yeah.
All right. So, in someone's choices of financial strategies to help manage and weather, prepare for weather, how can participating in investing be a strategy that is useful to someone's money management?
I think we all have that same puzzle, that question mark on our faces every time we talk about investing. But the reality is that there are a couple of different fundamental ways of looking at investing. One is to look at the potential um, of your money flow into you over a period of time, and match that against what you think you might need to pay for. For example, if you have young children, you would look forward to being able to help them get into college and all of that, and then their weddings and all of that. So you can sort of plan for some of those things and start to save away for it. Um, the second concept is to look further down the road and say, okay, what am I going to do to protect our family um, when I retire? How are we going to replace the income that one or both of the spouses are getting? How do you replace your income for retirement when you do retire? And that's something that you need to plan for. You need estimates, but look at those diligently. Part of it's going to be the Social Security, part of it's going to be the 401k, and then part of it's going to be your saving and investing along the line. So you have some broad elements to look at first. The second thing is making a decision between saving at the bank, buying bonds, or investing in the market. Okay. Um, there are so two of those, the bank and bonds, kind of tell themselves. If you're making something over whatever inflation is, if they're paying you 4% and inflation is 2%, at least you're moving up. you know but if you want to accelerate that because you have higher goals going in the future, or you think you do, um, the idea is to be able to say, how can I make more money? And that's kind of the thing that we all ask, how can we make more money and not lose any money? And that, so anyway, and there are ways that you can manage to that. Um, and part of one of those ways is using the equity markets, because they're actually potentially paying more above inflation to help you grow faster. And if you're prudent about how your selections are, that may well be an advantage to you going forward. Years ago, I used to do some seminars in Arkansas, in Bentonville, Arkansas, which you might remember is the home of where Walmart is. And I used to start the seminars off saying, I'd have probably, I don't know, a couple of hundred people in the room, and I'd start off by saying, one of the things I want to set straight with us before we begin is, you don't get rich investing. You get rich doing what you do for a living and saving, and you enhance that wealth by investing prudently. And pop up hands all over the back. So we just, they're probably out of 200 people, 150 hands went up. We would like to tell you that that's not really true. I said, oh, in I think it was in 1976. Sam Walton told all the employees that you're going public at $16.50. You'd have to check the dates on that, but and I want all of my employees to own at least 100 shares of Walmart stock, and I'll loan you the money and take it out of your paycheck to buy that first $1,600, for 100 shares of stock. So everybody did it. Here we turn forward to the early 90s. Those hands went up because that $1,650 turned into like 8 or 9 million.
I bet.
So I had to adjust my commentary on that to say prudent investing will then lend quite well to your growth of wealth. But anyway, so the whole point is if you're watchful and get the right kind of advice, for example, and not get too excited about the variability on a 6 month basis or a 12-month basis, but by quality, whether it's an exchange traded fund, which is basically an index, which gives you some diversification, or picking individual names because you're familiar, hopefully familiar with those companies and whether or not their sustainability as a company is good and they're going to continue to make money. There are other things that happen too that we've seen in the last couple of years where you've had some stocks split, you know, and those give us normal mortals an opportunity to buy some stocks in the environment that we've seen since 2008 too. So prudent choices, and not having an impatient attitude toward your holdings, but a reliability on still monitoring how your investments are doing on a reasonable basis. And of course, getting somebody to advise you well.
That's right. I know you've said it before, and we'll say it again. It can often be about time, not timing.
Yes, that has been a commentary that the pundits on Wall Street have said. The truth is that it appears when you start getting a little bit older, time it goes faster. You know, when you're young and you get started on a good program to save money and then invest it prudently, you have a long time to make up for the ups and downs of the market. You know, the standard deviation. I don't want to get off into all of that, but there's kind of an average that things tend to surround, going up and down with a reasonable amount of volatility most of the time. But the idea is that when you look at investing, and especially the older that you get, you have many more emotional feelings about that. You have more concerns about how you're investing, and time becomes our enemy at some point in time. The older that you get, the investments that you make in that arena, in that time arena, you have less time to have them work for you. But when someone has invested and tries to trade the market, that's much more difficult. It's not only that, but it attaches you to information and data flows that may take too much time in your life anyway. This is where an advisor probably comes in too. But in the final, and that not into the next final assessment of things, it's really good to have patience with it, but understand that your needs are going to change at some point in time. The objective for all of us is, to grow your assets and not lose any money. But when you start getting a little bit older, you have different plans for all of your money. And the first plan is you don't want to run out of it. But so the second is, what are you going to do with it? And how much do I need? And so there are questions that are changing throughout the cycle of life. So I hope that answered that question.
Yes, thank you. And um, would you say that questions like those are part of how you assess a client or potential client's tolerance for risk in investing strategy? Because you mentioned that in participating in the markets comes with an inherent risk factor.
Mm-hmm. Yes, and that's a very good question. Probably any really good financial advisor is going to have a system. It doesn't mean that you absolutely have to use a financial advisor of any kind, because I know many people who are as good and diligent as some of the advisors that I know in this business. But the fact is that you should start off with a financial plan. And what that does is you evaluate on that day or that period of time, that week that you're doing your plan, all of the assets that you have, all of the goals that you have, all of the potentials that you want to build for. Um, and you have sort of a, a pathway to reach what you want to do and have some idea of how you're going to have to do it. If you need help doing that, there's help available to you. But when you stop and think about it, I don't think, and I would have just put money on this one, even well prior to artificial intelligence, but I would venture to say that there is emotion on every financial decision that we make in life, some element of emotion. And that becomes a very important thing for us, particularly, I can't speak for every financial advisor, but it's important for us to be able to understand how much emotional risk a client can take. Because part of our job is to be able to assess that, compare it to a reasonable assumption of how much risk the market is allowing at any moment in time. And you measure those two, how much can they take versus how much they should take, right? And you find a balance in there. And those two things are monitored all the time. Both the client, whoever the client is, or whoever the investor is, you need to monitor those two things all the time. How much risk can I tolerate? How much should I really take? And how much you should take depend on what the flow of is happening in the economy, what the market sensibility is or insensibility sometimes. So those are constant, and they change over time too. They change with the cycle of life. It just, things happen to us in life, and it changes our pathway temporarily or forever. So knowing how much you're driven by your emotions is a very important feature. We have an ability around here, for example, to ask some right questions to be able to ascertain, help people understand what their emotional quotient is. You know what I mean?
Yeah.
And it could be just as simple as saying, well, first of all, finding out some of their history, what's been your experience, and generally speaking, what would you like to accomplish? And, take 5 years down the road. What do you want your life to look like then? Number two, 10 years down the road. I know you can't look that far, but what would be a good thing for you to be at that point in your life? So basically what I'm asking is, what do you want? Now, answering that question is a very interesting thing. A lot of people will answer it by telling you, well, I want to send my kids to college. I want to, do vacations. I want to, whatever they are along the way, those 5, 10, 15-year thought processes. And so they'll pretty much have that forward goal in mind. But then there are an awful lot of people that say, when they're looking at all of that, well, the thing that I don't want to happen in 10 years is this. I don't want a repeat of that, So those people are kind of looking in the rearview mirror, where others are looking through the windshield. And so we can determine that by listening to what they tell us. And then we can help them formulate a game plan that will protect that's the indication of their emotional tolerance. Generally speaking, when people are looking down and making goals and things like that, they actually are driven toward it. Okay. And those people that are constantly looking behind, not to make mistakes or whatever, they're the ones that say, I don't really want to take as much risk. So one will take more risk just naturally because their emotions point them in that direction. Their motivation points them in that direction. And Others, their motivation is softened because of experiences that they've had in the past. So getting to know the client diligently, getting into how they think about things and how they make decisions around things is a very important thing that we do around here. I can't speak for everybody, but we go through that. So planning and then profiling is those are two special things, whether clients do that for themselves or they get help from someone like us that help them think about those things. Does that make sense?
Yes, thank you so much. And to mention, if anyone listening does want to start investigating that for themselves, we have tons of resources on our website, www.wisdomchoice.net, including white papers like Investing Has Changed, Time to Change the Game, are the only game in town white paper, as well as white papers like the 7 Principles of Long-Term Investing, as well as our podcast episode, Participation and Protection. So you can check all of those out in our investing section of the financial intelligence tab or in our special news tab and on, again, www.wisdomchoice.net. All right,
Yes.
so that's all the time that we have for today. Thank you so much for deep diving into the decision-making environment in investing for us today. Next time, we'll be talking a little bit more about what you mentioned about the cycle of life's journey and how sometimes it can get in the way and to hopefully avoid detours. You
In
can,
the final analysis on that, it takes two. It takes two to get to where they want to go. It takes a good advisor or lots of data, and it takes a good client that pays attention.
that's right.
We make them better. In the
That's
final
right.
analysis,
Yeah, it's
we make
teamwork.
them better. That's right.
All right, awesome. Thank you so much, Jim. And thank you all for listening today. You can find ways to contact us if you want to ask for a specific topic or question to be covered on In the Final Analysis via email or contact form on our website. Again, everything can be found at www.wisdomchoice.net. Thanks so much. Bye.
Bye. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professionals before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Wisdom Financial Management, LLC are not affiliated.